Good morning, everyone, and welcome to the Nedgroup Investments Stable Fund quarterly feedback. My name is Anil Jagmohan, Senior Investment Analyst at Nedgroup Investments. Joining me today are William Fraser and Nick Balkin from Foord Asset Management, two of the portfolio managers of the Nedgroup Investments Stable Fund. The team at Foord have been managing the Stable Fund since inception in 2007. Actually, when I ran the numbers again recently, the fund was ranked number one in its category over that period, which is an outstanding result indeed, given that the fund has also consistently achieved its risk objective of protecting capital over rolling 12-month periods. Please note that we do have the Q&A feature available as well, and please send through all of your questions using the dialog box on the right-hand side of your screen. We will endeavor to address as many of these as possible before we close for today. Also, please note that if you have joined as an anonymous attendee, please submit your name via the chat so we can record it for CPD purposes. The session is being recorded and will be available online shortly thereafter. Thank you. William, over to you.
Thanks, Anil, for the introduction and the very kind words. And thank you for all the advisors and investors that has remained invested in the fund. We do really value your support and confidence that you place in Foord. So last year was a really spectacular year, to be honest, for investors that has remained invested in the stable fund. Given the volatility we've seen in local markets and international markets, we've seen many individual companies and investments not doing particularly well. And in that context, I think a return of almost 13.5% after fees is a really good result for a fund that aims to also preserve capital. So in other words, we do not take on a huge amount of investment risk in deciding where to invest for investors. And as Anila said, we've consistently attempted to preserve capital over rolling 12-month periods, which has been really a good achievement, I believe, in the last 12 months where we have seen the volatility in returns. So if we dig a little bit deeper into the different contributions for investors from a return perspective, you can see that there's really been two different buckets of asset classes that has contributed to the returns. And the one is on the domestic fund side, or investment side, being fixed interest, and the other would be the foreign assets, which is a combination of selection, but also a decision to invest in currencies outside of what has been a relatively weak rand currency. So you can see if you look at the last year, for example, foreign assets contributed almost 12% and fixed interest 4%, while local equities was down slightly. Property, even though we've had a very low allocation there, that allocation has been negatively affected by capital and county in particular. And then gold has been a really good contributor, even though the weight hasn't been that significant in the portfolio overall. This appreciation of the gold price as well as the rand depreciation has contributed towards a very good return for investors from a contribution perspective for gold in what has been quite a volatile period for investors and asset classes in particular. Now, the decision to be in bonds, we've communicated quite extensively to investors. And even though it has been a good allocation decision, it actually mattered where you invested. It wasn't a case of just allocating your investments to, let's say, the All Bond Index and you've done well. If you look at this contribution or allocation slide, for example, where we've compared cash to bonds to inflation-linked bonds, it actually didn't matter where you invested over the last 12 months and over the last 3 months in particular, where bonds have done well. So it has been a decision where your actual selection mattered. And I think it is better illustrated if you look at the different bucket returns on the All Bond Index, where the decision that we've taken to be in the 3 to 7 year bucket has been a major contribution decision for investors, even though the yields wasn't as attractive in nominal terms or real terms as the very long duration bucket of the All Bond Index. And you can see how consistently the 3 to 7 year bucket has outperformed the longer duration buckets of the All Bond Index. So the decision to be in 3 to 7 year bonds, which has really been based on where we see certainty in return of capital, so it was more a risk decision than an investment or a return decision, has been the right decision for investors. And we'll go into the reasons why we wanted to be in that specific area of the curve and why we think it is still appropriate, despite the yield curve steepening more. So in this slide, you can see just the change in the yield curve really over the last 12 months. And even 12 months ago, the curve was significantly steeper at the long end, or the yields higher than at the short end of the curve. But as the year has progressed and as interest rates locally has been reduced, you can see that the short end and the yields on the short end continue to fall, and yields on the longer end of the curve has continued to drift higher. So the long end increased by 1.5% and the shorter end by almost 3 full percent. So the curve steepened by around 4.5% over the last 12 months. And that clearly is not good for a capital allocation decision if you are at the very long end of the curve compared to the short or mid-duration position on the All Bond Index. And the decision to be in the shorter end rather than the longer end has been driven by a couple of factors, and it really continues to hold while we remain in the short and mid end relative to the longer end. And the first one is just given what is happening to inflation, and then it's not only locally, but it's also globally. So what is shown on this chart is the direction of inflation in different countries. So the darker blue, the block, the lower inflation, and the darker red, the higher inflation. So you can see that in most countries around the world, and in particular in SA, those blocks have become more dark blue over time. And in SA, the Reserve Bank really has missed the trick over the last 12 months. They've only reacted more recently to inflation and poor growth by reducing interest rates. And they should have done that a long time ago. And it's been part of the decision we've had to be in that 186 bond compared to other parts of the curve, because we felt that that bond in particular would react more to a reduction in short-term interest rates than other parts of the curve. So more recently, the bank has reacted, as I've mentioned, and inflation has drifted below the lower band or the lower part of the inflation target band of 3%. And it has a number of implications. The one is, will that low inflation number stay there or not? Because if it does stay there, it means that the Reserve Bank can cut interest rates even further. And it needs to go lower. We still have a positive real rate in SA with inflation at 3 and the repo rate at 3.75. And in order to get the economy functioning and, try and get growth at a reasonable rate in order to help us reduce the debt burden, the rates need to be more on the negative side than the positive side. So it's very important to focus on inflation and the direction of inflation, and in particular measure that relative to what the Reserve Bank's own forecasts are. And for those of you that read the statements and listen to the governor, you would have noticed that more recently he made a statement that if they've changed their view, that what we're seeing from an inflation perspective today is different from their own forecast, which is that inflation would only remain below the 3% level for 2 quarters in effect. If it stays there for longer, then further additional rate cuts are very likely. And that we believe is still going to be positive for a bond like the 186, given the short duration of that bond relative to other parts of the curve. Now, why we don't want to be as heavily invested in the longer end of the curve than the mid or short end is factors that I think is quite well known. And the one is that we are seeing a debt profile which is becoming unsustainable. And these are the Treasury's own forecast, which they put out last month. And I think it is, for the first time, quite a sobering and accurate presentation of where we are heading if we don't correct what is really becoming an unsustainable story on expenditure and therefore debt issuance. And you can see that by 2023-24, we are going to head into a scenario where the debt sustainability is going to be a real issue to consider. And if you are at that point in much longer duration assets from a fixed interest or a bond perspective, you face the real prospect of significant capital erosion. It doesn't mean that that is the path we're going to follow, because we can cut expenditure and we can increase revenue to bring the debt sustainability issue under control. But if you look at the right side of this particular slide, and what I did there is present expenditure both as and as fixed expenditure, so salaries, wages, and the interest that we spend on the bonds that we issue as a government, presented as a percentage of your total expenditure, but then also as a percentage of your total revenue. And that revenue part, I think, is really important. So almost 70% of every single, or 70 cents, if you want to look at it that way, of every rand that the government earns, we spend in those fixed expenditure bucket. So the point that we need to make here is that, yes, it's fine if you do cut your actual expenditure, but what you really need to do is increase revenue. And you can only increase your revenue if there's growth. And at this particular point in SA, that growth is going to be extremely difficult to achieve. So we need to make sure that there's growth coming through in the economy, because it's very difficult to cut wages, it's very difficult to cut interest payments, very difficult to cut social grants that we've, as a government, made available for people that really don't have any other means to survive. So that's on the fixed interest side. And we'll talk a bit later about the allocations, but it is still, we think, the safest place to be invested in SA. And you'll see I haven't spoken much about the equity selection locally. We can talk about it a bit in the Q&A, but if you look at risk versus return and where your capital is better protected, the bond side remains extremely important for investors, in our opinion. Now, why do we still have a gold allocation? A lot of the factors we have spoken about in the past, but really it's about what is happening to governments and fiat currencies, and effectively a massive increase in money supply around the world. And that money supply, as we all know, is no longer backed by gold. It's changed a long time ago. And the debasement of currencies means that if you adjust the quantum as what is happening today, you also have to adjust the price of the currencies. And in a world where there's effectively competitive currency devaluation, investors will look for other places to store the capital in real terms over time. And gold, we think, is quite a valuable asset class in a scenario where the future for currencies and the value of currencies is unknown. So you can just see here the correlation between the assets of the central banks of the US, Japan, and the ECB relative to the price of gold. And as the assets on the balance sheets of those central banks have increased, the value of gold has also increased in value over time. And the second way to look at it is, it's just what is happening to fiscal support. And we know with COVID and the reduction in growth in many of the economies around the world, and the attempts by the government through the Treasury Department to support the economy is leading to quite significant deficits. And again, how the government's tried to stabilize the economies is by going into further rounds of QE. And what's different this time, and particularly if you look at what's happening in the US, but it's also true for Europe and the UK and to some extent in SA, is that the QE is different. It is really through an increase in money supply, and that money supply is going directly to the consumer through either support for lost wages or through tax breaks or whatever the case might be. It's different from the past where QE has gone to the banks and the banks hoarded those assets. It's going straight to the consumer today. And if you have money supply where the growth is faster than nominal GDP growth and there's too much money in the economy, chasing too few goods and services, through time it's likely to lead to inflation. So the gold allocation is for part also to protect against the view that in time, what we're seeing today may well lead to significantly higher inflation. We don't see it today, as I've shown you in the previous slide. Inflation is continues where there's too much money being pumped into economies, then this increase in money supply is going to lead to inflation. So the inflation risk is high and it is increasing. And it's also true in SA. It's not only a global phenomenon, it's also, we think, a local phenomenon. And then lastly, on gold, it's just what's happening politically globally. And we've seen in the South China Seas quite recently, last weekend, where the US has been involved in military exercises and showing their strength and effectively threatening China to some extent. So this rise of China and Russia and North Korea relative to the rest of the world, I think, is something that we need to keep an eye on, but there's also many other events taking place globally which leads to concerns that there could well be an increase in volatility from a geopolitical perspective. And we think from that perspective, gold again can lead to a relatively positive outcome for investors through an increase in allocation and the price of gold. On the currency, and you would have noticed that the portfolio has remained relatively stable around the 30 to 35% in global assets. And for much of the time, it has been a decision that's been based on the valuation of the rand relative to what we think the values should be. And the rand traded at quite expensive levels, in our opinion, for a long time. It changed quite recently. So as the rand has depreciated, and we've seen quite a steep pace of depreciation from the start of the year at about 14 to almost 19, slightly over 19 for a short period of time in the second quarter. And at that time, in our opinion, the rand became relatively cheap compared to where we believe it should trade longer term. Now, the question to ask is, if that's your view, why don't you take a cut in your foreign exposure, reduce the allocation to well below 30% because the rand is cheap, and if you stay invested in foreign assets, there could be, because of a change in the rand value, capital losses coming through to investors in the portfolio. Now, as always, we are forward-looking, and we have to look at what we believe will happen to the currency in 12 or 18 or 24 months' time. And if you look forward and you look at what we believe is going to happen to the economy locally, what would you believe is going to be the right level for the rand, where are the risks, but more importantly, where are the investment opportunities? What are you going to do with your allocation in rand assets relative to offshore assets? Where are you going to be more certain of your capital if you stay invested? Where are the most returns going to come from? And to us, that decision is significantly tilted towards better outcomes in foreign assets compared to local assets. So while the rand might look relatively inexpensive, it's not as easy a decision as it seemed to switch into local assets. Flow funds is slightly more positive for SA. So we are, because of a change in the current account, switching from a deficit to a surplus in a slightly better position compared to where we have been for the last 20 years almost. So the trade balance have improved, and because there are fewer investors invested in foreign bonds and foreign equities, we pay them fewer dividends and interest. So this is slightly positive for the rand, but we think the flow of funds may well dwarf this income account over time. So it's not as easy a case to be made to be invested in rand assets relative to global assets. But we have to protect investors' capital, and we do, as I've mentioned, acknowledge the risk that because of both the current account and a slightly cheap valuation on the currency, and then also momentum, that there could be further appreciation of the currency. And one way to protect against an appreciation in the currency is through the options market. And what we have done within the stable fund is to enter into a zero-cost collar position. And in very simple terms, what we've done is for about 4% of the portfolio, or it's about 11% of the foreign component of the portfolio, we've hedged against further appreciation of the currency at levels below 17.95. So if the rand value falls, let's say to 17 or 16, about 12% of the portfolio will not suffer that change in the currency. And we funded that by a call option at about 19.25. So for any depreciation over that level, a portion of the portfolio will not benefit from that depreciation, at which point the foreign assets will probably be close to 40%. And we need to make sure that, just given the secondary objective, which is to preserve capital over rolling 12 months, we are not too skewed to one particular asset or risk. And I think limiting the exposure to foreign assets does help to offset that specific risk within the portfolios. And then lastly, before we're going into Q&A, is just a brief overview on the foreign component of the portfolios. And we can look at what's happened locally and the contributions to returns, but what we have to acknowledge as Foord Asset Management is the immense contribution that has been made by the foreign team and the foreign assets within the portfolio. And it's come in two parts, and the one is on the Foord International Fund, which is a flexible asset allocation portfolio. And what has been one of the major drivers of returns and preservation of capital within the Foord International Fund has been on the asset allocation side. And the way that they've managed to protect capital has been through the purchase of put options on the S&P, where they protected a significant amount of investors' capital at values on the S&P below 3,000. So effectively, we've reduced the equity allocation at the right time, and that's helped to preserve capital over the last year in particular. But year to date, it is extremely visible because the markets have been quite volatile. And you can see at this particular point in time what the hedged equity component of the portfolio is. So even though the puts have helped in preserving capital, we have rolled those, or partly rolled some of those hedges into future option strategies, anticipating that the markets are quite optimistic about earnings, in particular on the global markets. And the US is the most expensive, we believe, from the major equity markets globally. And we need to protect against the view that what is a quite optimistic earnings expectation from investors may well not be what is presented by companies. And one can just see, using what is at this particular point consensus earnings 1 year forward, how the PE on the markets change. And given that the S&P is about 31,550 today, and earnings are expected to be $140 in 12 months' time, it takes the PE on the market to quite significantly overvalued levels. It's about 25 times. So 25 times forward earnings, we think, is extremely expensive, given the uncertainty that investors face and companies face in quite a daunting macroeconomic environment. And then secondly, what has been, we think, the most important contributor towards the foreign component of investors has been the selection side on the global equity fund. And you can just see, if you look at the Foord Global Equity Fund after fees relative to the MSCI All World Country Index, that there's been about 11% alpha over the last 12 months. And it has been a period where the selection has come through despite a significant underweight allocation to the US market, which is quite an expensive market, as we've spoken about. So selection has come through on the global side, and we remain extremely optimistic about the companies that we have been invested in, given that they are trading on relatively low multiples for the outlook in earnings. And many of the companies are not reliant on fiscal stimulus to further grow their earnings, which I think is really important, because at some point, governments are going to run out of ammunition, and they're going to struggle to further support economies through an increase in money supply. There's certain limits that can't be done, or there's certain limits to money supply and growth that lowering interest rates cannot achieve, and we need to guard against those. And I think quite a bit of that has been priced into global equity markets and valuations. This is just a chart to show you some of the companies that we have been invested in on the global equity side and how they have performed relative to the MSCI World Equity Index. So the lower dotted line is the equity index, and the lines above that is the performance based to 100 over the last 12 months of some of the companies that we have been invested in. And you can see that selection really has come through in bucket loads. And for those of you that's familiar with Foord will know that returns are often quite lumpy. So there are periods where it seems as if the companies we have invested in is not contributing towards returns. But then for various reasons, and it can be timing, luck, it can be a shift in global political wills, that can all change the outlook for companies. And a lot of those things have come together in the last 12 months for these companies. And as I've mentioned, we've stayed invested in many of them, and we remain quite optimistic about the outlook for the future growth prospects of these businesses. I'm going to move on from this slide and rather talk about the allocation of the fund. And it's not really that different from where we have been invested in for the last 12 months. So we still believe that if you look at local equities and the prospects for earnings from local businesses, it's really quite an uncertain time. The allocation towards SA focused businesses is low. Overall, SA equity is only 10, foreign equities is about 25%. So total equity allocation of 35% is close to the maximum allocation of 40, but tilted significantly to companies where they earn earnings in global markets and in particular sectors globally. The majority of assets still on the fixed interest side and still within that R186 bond. We have extended the duration slightly of the portfolio. So as yields have moved higher on the 2030 or 32 or 35 bonds, we think the risk of capital loss have diminished, and for that reason we did increase allocation at the margin to longer duration assets, but still so much tilted towards the 186 bond. And then commodities through the gold allocation we think will remain quite an important part of investor portfolios in a world that is still so uncertain, and I've spoken about the reasons for that. Gold is an asset that behaves differently from many other assets that we can invest in, and I think from that perspective it is important to remain invested. I haven't spoken about equities through the property positioning within the portfolio. It's been a low allocation at 3%, it's remaining low. There's a lot of uncertainty on the globe, on the local property side. We think distributions will be under a lot of pressure, but the capital, importantly, will also be under a huge amount of pressure. And for that reason, we'll rather wait for more certainty to return to the local property market and the outlook for distributions, but importantly on the balance sheet side before we make a significant change in allocation towards property investments locally. Anil, I think I'm going to stop there because we're almost at 30 minutes and rather open up for Q&A and deal with the Q&As.
Okay, great. Thanks very much, William. There are a couple of questions here. So the one you actually subsequently touched on about the rand is actually quite weak at the moment, and when we do see a strengthening of the rand, how are you guys positioned and how will you manage that? I mean, besides what you mentioned on the call, any other comments that you'd like to make at this point?
So I'll make one comment, maybe two. The one is that we're not investors in dollar assets globally. So a lot of the companies we invest in has a diverse sources of earnings, and it's not as clear-cut a case that should the dollar weakens or the rand strengthen, that the global positioning will be affected on a one-to-one basis because of what's happening to currencies. And secondly, we are reducing the allocation to the foreign assets other than through the options because, number one, the markets have done well. So we think from a capital preservation perspective, we can better protect investors' capital at the margin by investing a bit more in, let's say, the 186 bond, for example. So there are a little bit of a reduction taking place within the portfolio, just from a risk management perspective. But the opportunity set globally, we think, through the increase in earnings that companies can achieve, is by far the best way to protect capital longer term in real terms. And that's what we're trying to achieve.
Okay, thank you. And just maybe it actually ties in quite nicely with the next question, which is just your thinking around how you balance the portfolio. So looking at your government bond position versus your offshore holdings and how those kind of create a robustness in terms of market volatility.
Yeah, I mean, that's the art side, right? I mean, we try and always have balance in our portfolios. We are very cognizant of the type of investor that has been invested in the stable fund, and in particular the needs that they have from either an income perspective, but also from just a certainty of capital perspective. So the first part of the equation really is in terms of the security of assets that we invest in. And if you look at where we invested on the bond side and the short to middle part of the curve, which offer a real capital and income return in excess of 4% of inflation when we initially invested, where the risk of losses really is low and was low compared to property locally or equities locally, where the risk has been significantly higher. Now, to us, that decision to be in something that gives you a certain return of 4% over and above inflation, which meets the investment objective of the portfolio on the local side, has been quite an easy decision to make. But that only gives you inflation plus 4. So you need to find other investments that you believe through time is going to deliver significantly more than inflation plus 4. And the global equities did give you that opportunity in certain sectors and certain companies. And that gives you the other part of the equation, which is not only real protection of capital longer term, but also real increases in earnings and dividends that you receive from those companies, significantly above inflation plus 4. So we have to balance risk versus return, and more importantly, certainty of return, which isn't always that easy if you look at volatilities based on past correlations. It is much more about the future and trying to look at the future expectations for earnings. Nick, do you want to say something else in addition to that?
No, unfortunately, I'm having a few technical issues, but I hope you can hear me. Carry on. You answered it fine. Okay,
thank you. And then just in terms of globally, and let's start with the thematic view initially, but where are you seeing value at the moment? Before we get into the stocks, let's just talk themes at the moment.
I'll try. Can you see me and hear me? Just give me a little thumbs up, Anil.
Yes, go ahead.
Okay, cool. Yeah, I think Will did touch on it, and he showed you our top 5, and he showed you, where we slant in the portfolio. But it's all about trying to find gaps where we're small in global terms, and we can find, as I've mentioned on previous call, niches that will continue to grow whether the market does well or not. Also finding companies that will do well if things get worse and people, I guess, can't go out or not. So finding that optionality and small companies where they can grow in all terms. So just using an example, on the bigger side, JD and Tencent, you can see our big holdings in the global fund. And they've continued to do well in most scenarios, and we think that they great long-term holds. So I think we've spoken about them before. The other segment on the kind of other angle is the biotech and the pharma companies that we've spoken about on more than one occasion, where you can buy and hold companies that have no correlation to the market whatsoever. Whether the drug does well or not will not be dependent on how the economy is going. So I think we're able to find those niches where we're confident that we found companies that will do the business over the long term, no matter what the cycle is. And I think if you can find companies like that, it gives us confidence to hold equities. To hold the S&P as an amalgamation in the portfolio, that's less exciting to us, as William showed you on some of those charts. The S&P is at the long-term range. We need to be more innovative and smarter about the niches that we're looking at. I hope that answered the question.
That's great, thank you. And then maybe just in terms of some of the actual stocks, what are like really interesting that you're seeing right now, especially as we've seen, some sectors have really bounced significantly. Some sectors are even above their previous high points. So where are you finding value at the moment, which potentially it's not a value trap as well on a stock specific basis?
Yeah, I think our best stocks and our best ideas are our biggest holdings. There's no secret. We concentrate. So if you go back to the presentation that we'll put up our top holdings, we wouldn't be in those companies if we didn't believe that those were our best ideas. We'll just flip back to it. But the point is, and you can see the examples, Activision is a gaming company that we liked before COVID. So, whether their games do well or not, they're only enhanced by those sorts of issues. So if we can get that optionality where people use the company more or the products of the company more as a result of it, then that's great. But if things continue as is, then it will still be good. Those are the companies that kind of excite us. On other angles, we were able to pick up that RPG, which is a great company. It's really in the theme of automation. It's providing the shovels to factories that are automating because it provides the laser that cuts in the automation of a factory. So those are the things that excite us. We can either find a company that's really great and on a good wicket and we want to hold it for the long term, or we can find companies like RPG, which fell down when everyone thought manufacturing was disappearing, and then we're offered a good entry price for the long term. So I think it's an amalgamation of holding what we've got because we think they're great, and picking up one or two items that were selling off indiscriminately in the sell-off.
Great, thanks, Nick. And maybe just a bit of a compound question. There's quite a few components here, but partly just given where the state of the South African economy is and why you selected kind of the middle of the government bond curve, not anything shorter or anything longer than that, and then just maybe a bit of a view on interest rates over the next 2 years or so.
Yeah, I think we've spoken about the 186 bond quite extensively in the past, and number one is the bond offered a really high real yield of between 4 and 5% when we first invested, in a world where we believe inflation was trending lower because of the pressure that the economy faced. While at the longer end, the challenges that we believe the government was facing was only going to worsen, and therefore your certainty of capital through time was less certain being in the long end. And it's not only about capital and what you might earn from that bond if your yield either reduces or stay the same and inflation decreases, but it's also about the income perspective. And And we like the 186 bond from an income perspective, given the importance of income for many of the investors in the stable fund in particular. And a 10.5 coupon translated into an interest yield into the portfolio for that bond of about 9.8%, given where we purchased. In a world where we believe local rates should fall. So you're getting a constant interest component of 9.8 in a falling interest rate world where inflation drifted low over time. So, which we thought might be a 4 to 5% real return, is translating into almost a 7 to 8% real return on a 186 bond. And that's really what appealed to us. And as you've seen in that one chart where we've put the increase in debt potentially to GDP, if we don't rein in spending, if you go out too long and you are unsure what is going to happen to debt and the ability of government to repay you, you don't want to be in an asset that might have a high yield, but you may not get your money back. Or if you get it back and there's inflation, you're only getting back 50 cents of every rand that you invested. That risk to us is significantly diminished in a bond like the 186, where you're getting a lot of your capital back in interest over time, given the high coupon.
And I think that fits with exactly what Foord are about, right? And it's underappreciated because we've always said we can enhance our yield substantially by buying more long duration bonds. It will give us a bigger carry. It will, in the short term, feel better. But I think the danger of reaching for yield is something we've always cautioned against. The other benefit that Will didn't speak about on the 186 is the liquidity, right? There is so much liquidity that we can sell our whole holding in the 186s actually across the whole office in a day or two. I mean, that's the kind of liquidity you get in the 186. So flexibility, liquidity, it's in that right place where we have confidence that we'll get our capital back against an inflation rate that will be under control for an acceptable yield. So I think those things we've spoken about. We're prepared to accept a slightly lower return for more security, in summary, against inflation.
Okay, thanks very much, guys. And to you and your team at Foord, just amazing and outstanding efforts in managing the stable fund on behalf of investors since 2007. To our dear investors on the call, just as a reminder, we do have upcoming report backs this afternoon, 4 p.m. That's the balanced and managed funds, as well as tomorrow morning, the opportunity fund at 10 o'clock. And then next week, we will be hosting our global fund managers for an update on our award-winning offshore range as well. So please look out for the invites to those events. Please contact your relationship manager if you have any further questions. Otherwise, we look forward to connecting with you again soon. Thank you very much. Enjoy the rest of the day.